Hi, and welcome to a financial planning podcast. The down to earth vibe Sasquatch listens while dusting his abode. This is Through the Pines. On this episode, we will discuss managing your own money. Should you do it, or should you hand it off to a financial planner? Questions like: do I have the passion and consistency to maintain an investment portfolio? Do I have the competency, background, and confidence to build a portfolio and stick to it? Do I have the time and long-term discipline to regularly invest or reinvest and do the research? Will my portfolio stay within a percentage or two of a professionally managed portfolio? Finally, why can't I just buy and hold something? We'll answer these questions and more on this episode of Through the Pines. So bringing in our advisors for this episode, Forbes Best in State Wealth Management Teams for Utah, along with the Advisor Hub fastest growing advisors to watch under $1 billion, receivers of the Ameriprise Client Experience Award. We have Rex and Brandon. Rex Baxter, Brandon Smith, planwithbaxter.com. Rex, thanks for joining us on the program today. Tell me why I'm not smart enough to manage my own money.
Well, before I tell you why you're not smart, then let me just say thank you for having me on the show. Let's start with that.
Sure. Yeah. You can butter me up a little bit first.
Yeah. Let me butter you up. It's interesting because we honestly take the stance that all of our clients, right, are really smart, right? And most of them are extremely smart in different areas, typically in their own field or an area of interest and things like that. However, just because you're extremely, brilliant in one area doesn't always translate to other areas. And so it's not that you're not smart, you're very smart, right? I mean, you can run a podcast, you can run circles around me in the podcasting world.
Amen to that.
Amen to that. And so, I mean, you look into the camera, you have the right light, you have the microphone, the headphones, you've got the technology, you've got the tools. And I don't. I would just be, playing at your game. So I think that's what it comes down to is people are smart and they're plenty smart. And if somebody wants to focus in that, they can do that and they can do all the reading, they can do all the research. They certainly have that ability. Lucky for us and the ability for us to live our dreams, a lot of people choose not to make that their passion and not to make that their hobby. And that's lots of times who we work with is those that are too busy or don't tend to have the interest or inclination to do it and haven't spent the time to educate themselves on how to manage money and how to do their own planning.
So, well, how long does it take? In other words, if I was going to manage my own money, doesn't it take like once a month sitting down and looking at my income versus outgoing and my investments and just take a few hours each month to manage my own money? Like, what does hiring a manager, a professional, do that is different from someone just checking their portfolios weekly, monthly, something like that?
Well, I think there's a lot that plays into that. And it's not just the managing or rebalancing of the portfolios or not just putting your cash flows and measuring your net worth and looking at different variables and projections. But I think a lot of it is behavioral as well. And you'll hear us frequently say that, people make terrible decisions when they're emotional. And what do people get most emotional about? Their money. Right. And so typically people, when they get emotional about their money, they make terrible decisions. And it's nice to have someone there to bounce ideas off of to see if you're really making a good, logical decision and thinking with a clear head as you're making those decisions. And so I think that's a lot of what advisors bring to the table.
So you do have a large portfolio of clients. When you come across someone who has managed their own portfolio for a certain amount of time, what's one of the main mistakes or areas of improvement that you notice right away?
Brandon, do you want to chime in on this one?
Yeah,
he's like, I'm ready.
Usually it's rate of return, right? Like you look at it and the management of the funds it just wasn't right. And what happens, and it's interesting because I'll oftentimes ask people, so how do you choose it? Not trying to pin them down and say, what were you thinking, but just curious. And And I mean, it's the answers I get, you would be astounded by, right? People, well, I don't know. I just kind of selected all of them and split it between, or they will, one, I heard a guy just looked at all the past performance from the prior year and said, whichever ones did the best, he like took those top 2 or 3 and put it all in that. The problem with that is, why did it do well, right? Did it just, essentially, we all know that in investing, we want to buy low and sell high. Well, if you're looking for all the ones that have just run and gone high and you buy all those, you're doing literally the exact opposite of what you should be doing. And so we kind of came up with these topics because we get this a lot. And like Rick said, anybody can manage their own portfolio. It just, do you have the time? Do you have the competency? And if you do it, are you going to stay within that realm, right? Within that price range of if you had just paid someone to do it anyway. And so we wanted to go through these questions and really answer each of them. The first 4, if you can answer yes to the first 4, then I think you've got a pretty good shot, of managing your portfolio. If you come back and you say no to even one of them, it really probably would be in your best interest not to try and manage it yourself, just because the stakes are so high, right? What happens when you manage it poorly is dramatic. I mean, we can lose hundreds of thousands of dollars if we do this wrong, or
maybe millions. Yeah. So the questions, 4 questions, like you said. Okay. So number 1, do I have the passion and consistency to maintain an investment portfolio? So passion is arguable, but what do you mean by consistency?
Yeah, you can't just this, and we get clients that will get into stock or trading, right? And sometimes right when they retire, they have nothing else to do, so they're like, hey, I'm gonna really get into this and start doing a lot of research. And there's nothing wrong with that. Sometimes it's good mental stimulation with a real purpose to actually research and choose and pick stocks. But most times those clients will just carve out a piece, right? And then they'll run those decisions by us so we can make sure they're doing the right thing and not getting too out on any far edge. But for the most part, right, if this turns into just a short-term hobby that you do for 3 months and then you forget and time goes by and you haven't looked at your portfolio for 6 months, a year, 2, 3, 4 years, well, then all of a sudden, we may have missed some significant opportunities. And so when we say, do we have the passion and consistency to maintain a portfolio, it needs to be more than just a fad for you, right? It needs to be, hey, I'm going to be dedicated in consistently researching these things, right? We might buy this stock or this ETF today, but 6 months from now, that might be the wrong decision, or that weighting, that the amount we own might be the wrong decision. And so are you going to be consistent in monitoring and making sure that all your decisions are where you want them?
Okay. So what's the difference between using a financial planner to manage a portfolio and someone who wants to just, play in the market and trade stocks, do some day trades and stuff like that?
I think a lot of it is outcome and how we're building the portfolio, right? When you say day trade and pick stocks, I think that's fun, and I think a lot of clients enjoy doing that. But the last thing you'd want to do is take your entire life savings and your retirement and place it on a bet, right? And so when people come to us, most times, like Rex said, they're not interested in us like giving them day trading advice or the hottest stock to buy, right? They're interested in getting consistent, reliable returns and doing the best thing they can with their money, right? Making your portfolio as efficiently as possible to accomplish goals like retirement, vacations, things like that. And so when we manage money for clients, we'll sit down with them, figure out what their risk tolerance is, right? How much can we allow this portfolio to move in return for growth, right? And help them kind of put those 2 things together.
Rex, what's consistency over time mean to you as far as building a portfolio and managing it?
So consistency over time to me means somebody that's going to spend time regularly on a regular basis, whether that's daily, weekly, or monthly, certainly not longer than that, in analyzing their investments, looking at what they own and why they own it, and making sure that it's still in alignment with their overall risk profile. And I think being able to do that month after month after month after month is the consistency component of that. What we find a lot of times is somebody, again, will get extremely passionate about it for very short windows of time. They'll get passionate about it for a month or two, and then all of a sudden they'll get distracted with life, with family, with work, with a hobby, with a side hustle, with something. And then all of a sudden it sits there dormant for 6 months, a year, 5 years, for some amount of time. And then they look up again, and then they get passionate about it again for another 2 months. And then that cycle continues. That's not consistency. And so, at least not in my mind. I mean, it's consistently inconsistent, I guess, if you want to put it that way. And so I think that's what we're talking about. I do think that there's a distinction between, you reference financial planners, and I know it's a terminology issue, but not everybody that does financial planning is a portfolio manager and manages portfolios. Brandon and I are accredited portfolio manager advisors, meaning that we manage money as part of our business. And so I think that when you're looking at different financial advisors and you're looking at different, people that are working on your planning, things along those lines, that you ensure that they're qualified to do the job that you're hiring them to do. And so you don't want to go, to, somebody selling auto insurance to get your car repaired necessarily, if that's a good example. So,
okay. All right. Well, Rex, talk about your competency then, because you've been in the industry since essentially you graduated college. But so what type of competency does it take to manage your own money, have the background and this is question number 2. So if you can answer yes to this, then you should manage your own money. Do I have the competency, background, and confidence to build a portfolio and stick to it? How much do you need to know? How much competency is that versus, and like you said earlier, it's not necessarily an intelligence or smart thing, but maybe an experience thing.
Yeah. So I think we're always learning, right? And so, we're always reading, we're always learning. We're paying attention to the markets. We're paying attention to the financial literature that's out there, and looking at different strategies, looking at, different things that are being done in the financial markets. Now, both Brandon and I do have, financial degrees from accredited universities. We're both accredited portfolio managers. I have 25 years of experience. Brandon's got over a decade of experience. And so, we do have quite a bit of experience in managing money and managing portfolios, and we understand risk. We understand, all of the, the Greek alphabet that's dealing with finance, the alphas, the betas, the gammas,
Rex, I read The Millionaire Next Door.
Oh, you did?
I read Think and Grow Rich.
Great book. Another great book.
I read, you know what I mean? Like I read all these books. I got it. It's under control. I know what to do now.
I think,
go ahead, Brandon.
And I know you're baiting us with that, obviously. Right?
No way.
But things do change. Interest rates, environments change, right? What worked 10 years ago doesn't necessarily perfectly translate over. I mean, you can roughly get it, but you're not going to squeeze out all the juice that you can get, right? And ultimately, why wouldn't you have someone else do it? Usually it's because you're trying to save on cost. And then if we don't get all the juice out of it, even though we saved on cost, we end up with less money, right? Okay. And so are we going to subscribe to different research analysis programs? Are we staying on top of macro environments globally, as well as fiscally and everything else going on within the world of finance? Are we up to date so that when everybody else is shifting the way that they should, are you being left behind or left out of it? And is that going to end in a costly error? The other thing that I'd like to point out too is anybody can build a really good portfolio that they feel really good about when the markets are up. When markets are climbing over and over and over again, people it feels good, right? You pick something. You may not have picked the most efficient thing, but you picked something and it grew and it feels good. But then what happens if all of a sudden the markets crash or they start going down? With our clients, we can sit down and say, hey, we planned for this. We didn't know when the markets were going to crash, but we knew they would. And this is why we built the portfolio like this, so that we can weather these storms. Here are the minor adjustments we've made because we had to, right? With changing markets. But having that fortitude to stay the course makes all the difference in the world. The only clients I've ever talked to, the people I've ever talked to who are still in pain from 2008, and I didn't have them as clients in 2008, but the ones that are still in pain from 2008 are the ones that didn't have the fortitude, they didn't have the confidence to stick with the plan. Everybody else recovered in about 4 years. It wasn't like a devastating event if you had your portfolio built properly and you had the confidence in the portfolio to ride it through. And I don't think that changes in the future. I think there will be more events almost for sure like that, where you have to have confidence going in and be able to ride it out and get to the other side.
All right. So you brought up cost, Brandon. So what's your response to those who say, well, for the cost, I'd prefer to manage my own money?
Yeah, I'd just say, and recs are incredibly straightforward, right? We typically, not always, but typically are charging between 1% and 2%, right? Depending on assets. If we're managing more, it's lower. If we're managing less, it can be higher. But ultimately, I mean, if you're looking at that, is your portfolio, let's say you're at 1%, is your portfolio going to stay up and keep up with our portfolios that we're regularly monitoring and watching and making adjustments to? Are you going to stay within 1% of that performance long term? And if the answer is no, or I'm not sure, then it probably doesn't make any sense, right? Why would you, if we're going to do it for you and then do a better job, we've kind of earned our keep on that, right? And then in addition to that, we have the extra management and making sure everything, is looking good. So anyway, just thought that was, yeah.
Rex, what's your answer to those who balk at cost?
I think there's a saying out there that's been quoted in many, many books, but cost is only an issue in the absence of value. And so, those that see the value in what we bring and experience that, understand that the cost is a small percentage of the picture of what we bring to the table. And it's not just performance, right? It's also, managing and navigating the behavioral side of this. It's also the financial planning. It's also looking at different financial strategies to try and minimize taxes or increase the amount of money that we keep from generation to generation, and kind of your legacy planning or more efficient ways to gift money, all of those other things that financial advisors bring to the table. And so I think, cost is that issue, but I do think that there's such a media push on cost that people are hypersensitive to it. And I think it's appropriate to be, sensitive to it and aware, because you don't want to overpay, because that does, at the end of the day, it takes money, away from the final picture. The question is, are you getting more in value for that cost, or are you not? Obviously we're in business because we are firm believers that we bring
Value.
Plenty of value
to bring bling. I mean, I'm okay with bringing the bling. I like this Facebook comment because it said this Facebook user says, I'm sold using a financial. So there's the cost that you guys incur that you charge the client. But then this comment says, using a financial advisor has not only helped my portfolio, but also saved me from making expensive mistakes. So there's a cost there in making a mistake. What are some of the mistakes that someone can make if they try to manage their own money?
Well, I'd reference our other podcast, all the mistakes. Yeah. And we could go on for days and days about mistakes. And whoever made that comment, they're absolutely right. Sitting down, I mean, us managing a portfolio, do I believe that we can, outpace and help someone with a portfolio and manage that money and make up the cost? Absolutely. But beyond that, the costly mistakes, I mean, that's a huge piece of this, that we'll meet with clients and they'll tell us what we're doing, and we'll say, have you considered this? Or are we sure why haven't you considered this? And it can make huge, huge differences in portfolios. And so, yeah, great comment.
Okay. All right. So number 4, the fourth thing that you said, if you can answer yes to, then go ahead and manage your own money. Do I have the time and long-term discipline to regularly revisit and do the research on your own management? In other words, it takes a lot of time, right, Brandon?
It does. Yeah, it takes a lot of time. And there's kind of efficiencies of scale, right? With Rex and I, it would, the amount of research that Rex and I do on the markets, economy, and the everything else that goes with that would be absolutely ridiculous if we were just managing our own portfolios. But what's nice is then we can take that knowledge and bring that forward and use it with all of our clients and help manage clients' portfolios. And so there are massive economies of scale when using an advisor.
Okay, so Rex, we can do a lot of research on our own. There's this thing called the internet, ChatGPT. I think I saw ChatGPT built a portfolio that was crushing. Actually, someone said like, build me a portfolio, and it was crushing, which is fantastic. How much does the business that you work for and the I guess all the places that you can pull from to get intelligence on financials, how does that help you build portfolios to stick to and be disciplined over time?
Well, I think it's interesting because anybody can build a portfolio with a rear view mirror, right? If you ask me to build a portfolio and you're gonna back test the number, and you're just looking at a static investment, then you're going to look at whatever performed the best over the last 3, 5, 10, 15, 20 years, right? And that's, of course, that's what you would have invested in. Duh, right? And so it's easy to invest in a rearview mirror. The difficulty is investing looking forward and trying to make good, educated decisions on where you think the opportunities are without taking on undue risks and getting your portfolio out of balance to where if you're wrong, that you have a very expensive, costly mistake that sometimes can be compounded with additional mistakes like selling out and panicking when it's low. And so I think that's an important thing to kind of keep in mind, is that's what we're doing, is we're building portfolios looking forward, not backward. And we're managing those as we look forward, as information changes and comes to light, as the Fed looks to slow down interest rate hikes, as inflation starts to maybe levelize a little bit, as Russia invades Ukraine, as a president gets shot, as all these different things that have happened throughout history. We're trying to look at that and say, okay, how does this impact things going forward? What's changing, and where do we need to be positioned? Where, how do we skate to where the puck is what we're looking to try and do. And are we always right? Absolutely not. Right? We're absolutely wrong sometimes, but we are right more than we're wrong. And not only that, but there's so many other ancillary pieces that come into managing money and strategies and looking to make sure those dollars are working efficiently for you, that you're missing out if you're not working with an advisor, that you may not have the experience to know what questions to ask. So part of your question was, where do you go to get information? Was that part of your question, I think, Brandon?
Yeah. In other words, like what are you plugged into that maybe the everyday investor may not have access to, or just doesn't have the time to access, because that's your business. It's literally your job. And so do you get emails every day on what's going on? Like, how do you get the information that you get, and how does that affect portfolios and potentially how you help clients invest?
So yes, we get emails every day.
Important ones. I mean, good ones.
That's what I took from your question. No, I'm just kidding.
Yeah.
But we obviously lean on Ameriprise's research. Their economist was just ranked, I believe, Brandon, correct me if I'm wrong, but I think that he was just ranked either number 1 or top 3 or something like that in the nation for an economist. He's
number 1 in our industry, right? Kind of serving financial advisors, and the number 4 worldwide.
And so he sends out something once a week or every day or something, like, okay.
So we get commentary from him every week and some commentary, every day, and certainly during, big dislocations in the market as far as what's going on. And so we have access to that. We brought him out. Ameriprise brought him out to Utah here about 2 months ago to talk to a number of clients. And so, we do get access to that, but we also have, access to other professionals in the industry, other economists, other market strategists, quantitative and qualitative strategists. We have access to additional investment research from many firms, whether it be Morningstar, S&P Research, and Thomson Reuters, and things that, First Call, and many others. And so most people can gain access to that research. It just takes money, right? And then it takes the time to know what you're looking for. And it takes, that experience and knowledge to understand what you're reading and how to apply it to your investment portfolio. And that does take some time, right? Investing is not all science, or else there would be a perfect portfolio that everybody in the world would be invested in. It's an inefficient market that is, I always like to say, is half art and half science. And so you need to have a talent and a little bit of skill for investing, in addition to the scientific, or mathematical knowledge, financial knowledge, in how to assemble those portfolios.
All right, Rex, help me sell this.
Help you sell this.
Yeah, because
okay.
Some of your hardest clients are maybe those who are numbers people, mathematicians or accountants or something, right? And I'm going to assume that they probably think that they can figure it out on their own. They can manage their own accounts. And so my question would be, well, what's your time worth, right? And so is it still worth it to just pay somebody like you, like a financial planner, to do all that for you, so you don't have to worry about it? Like, what's your time worth?
Yeah, and I think it comes down to the individual, right? Mm-hmm. And so we work, the example we like to use a lot is engineers, right? Because they typically are very methodical. They typically have the processes in place. They do their research. They, and so they spend a lot of time. They come to us with lots and lots of different spreadsheets, with extremely complex formulas most of the time.
Do they really?
Yeah, absolutely.
And what do you do?
They'll want us to analyze what they're doing, right? And so we'll look at it, and if they want to do it on their own, that's great. We'll kind of point out, did you think of this? Did you think of that? And they're like, well, I got around that by doing this. And I'm like, well, you can't really get around that, right? I mean, that's not something, like somebody was using straight line inflation.
I don't pay taxes.
Right. Or tax rates will never change.
Okay.
And it's like, well, but what if tax rates do change, right? Then how does that impact all of your financial prognostication, right? All your forecasts. And so it's always kind of interesting. And there's certain personalities that just are not good fits, right, for us. And life is too short to work with, to work with people that are contentious, and to work with people that are, that are always kind of battling. At the same time, we welcome the challenge. We welcome that. Sometimes those conversations are extremely stimulating and kind of fun to have on some of those conversations.
Well, yeah. How many times has someone come to you and they were managing their own money and it didn't go well, and then they finally made the call?
Lots of times. Yeah. There's plenty of times to where, a couple of things will happen. Either somebody will come to us and we'll manage part of the money, they'll manage part of the money. And then they find out that they really aren't putting as much time, effort, and energy into it as they thought. Or they don't enjoy it, or they value their time more than what the cost is. And so then they end up changing directions and just kind of, reviewing it and letting us manage it, and kind of handing those reins over. On the other hand, you get some people that will, come to us, come for advice. We'll evaluate the portfolio. We'll give them some advice, and then they'll go off and try and do it on their own for a while. And then they'll come back and see that it really, that our portfolios have changed and modified and kind of, adjusted to the times, and they're still in that static portfolio, right? And therefore they've lost out on some of those changes and some of that performance over time.
Okay. Well, flip side, how many times have you run into a client where you're like, oh my gosh, you're crushing, keep doing what you're doing, you don't even need us?
Right.
So I'll take this. So sometimes it's happened, right? And they'll come and they'll have a portfolio that's just like It was just like blowing it away, right? And the question is, was that luck or is it repeatable? And, I had a client that was doing that and just multiple times, actually, I've had clients come to me and think that they figured out like a nuance to the market, right? We do this, we do this, we do this, and we get profits. They do it over and over and over again. And unfortunately, without fail, multiple stories of this, they'll then tell their friends, they'll tell, they'll start other people getting into it. And then it'll just, they didn't know everything going on, right? They missed a piece of it and collapsed not only their portfolio, but someone else's. And so that comes down to understanding the risk, right? Rex said, we're not always right. We're wrong sometimes. And he's right. However, when we're wrong, we make sure that when we're wrong, it doesn't destroy a portfolio. We make sure that those risks are covered. And so that, one company going bad or 5 companies going bad isn't going to blow us up, right? We're going to be just fine. And understanding the risk and understanding the return is incredibly important. Because at the end of the day, if your goal is to dramatically outpace the market consistently, it just doesn't happen. If it did, everyone would do it, right?
Okay.
And so it's important to understand where return is coming from.
So Brandon, how do you prevent so there's a lot of famous people who were involved in the downfall of this latest crypto king guy who took a crap. What was the name of his company? Which one?
Was it FNX?
It's something, but I mean big names. I think Shaquille O'Neal got served papers and some others who were like, because they endorsed investing in his crypto company or whatever. He was in the Bahamas or whatever, hanging out. Or I don't remember where he was, but he's in trouble. So people that have status, have access to people to make decisions for them, to help to make good decisions, still got caught up in, or can get caught up in, inadvisable investments, I guess. And so how do you guys steer clear of that type of thing?
We don't take on dentists. Just kidding. That's not true at all. No, sorry, that was probably an inappropriate joke. But I can't tell you how many times dentists have just signed up for the worst. Is that
true? Really? They just dive in, huh? They're just
constantly. I don't know. And it might just be a weird microcosm.
They're like secret rebels. They just like to invest in all the things. We don't know.
Honestly, what I think it is there's a stigma, right? Hey, they've got money, and I think they get approached by bizarre investment deals. And the fraud, the world of financial fraud is still alive and well, right? Ponzi schemes are not done.
It was FTX, by the way. Yeah, FTX. Sam Bankman-Fried, FTX. Yeah.
And so I think it's important to understand. Again, it comes down to risk. What is the process? What are we buying? What do we own? What is the process of managing it? But yeah, you have to absolutely understand it. And we'll have clients come to us and they'll say, hey, here's my deal, right? I was talking to a neighbor usually, or a brother-in-law or something, and he can get me a guaranteed, 8% or guaranteed 9%. And you have to say, how is that guarantee coming, right? Who is guaranteeing it? What is backing this? Because really it's not FDIC insured, right? And so what happens if, and just working through those questions, it's important that there are processes, there's diversification, and that we understand exactly, just like kind of like Warren Buffett stuff, right? You have to understand what you own and why you own it. In order to really feel comfortable and be able to ride through the downturns.
Yeah, we were talking about that before the podcast. There's 5 hours of the annual shareholders meeting for Berkshire Hathaway on YouTube. So if you want like all the gems, go check that out. It's good listening. It takes 5 hours of your time. Brandon, do you have some more numbers? I don't think we hit it in the last podcast.
No, we don't. I took the best of the two. So
okay.
Bespoke Research. So there's a saying out there, and tell me, have you heard of it? Sell in May and go away.
No. Yeah. What is this?
Sell in May and go away. Kind of the theory. The theory is that May is a bad month to invest in. So just sell all your stuff in May and then go away, right? And then come back and invest it later.
Okay.
it's interesting. Bespoke Research did
Wait, let me finish the saying really quick. It's sell away, it's go away, sell in May, and it's remember to reinvest in September or something like that. And so to kind of get back in, so you essentially take the summer months off, and anyhow, it's something. There's a good rhyme in there.
As if the market
listen.
doesn't go up in the summer. Is that what they're trying to say?
Well, they're saying that because people go on vacation, that historically there was a period of time where the summer months were a little bit underperforming. And when we say underperforming, it might be by 1%, over the other months, right? And so it's not like, oh, you're going to get 0 during these months and you're going to get 10% during these other months. It was a minor difference, but because people take vacations, and
I love these guys who come on the financial channels, and they like, and this is not necessarily what you guys do, because you probably don't sell that much, and that frequently or whatnot, but they'll come on the financial channels and it's random stats like that, right? And they'll come out and they'll say like, well, 6 months before an election, this happens, or 2 months after a new president, this happens, and they have all these things that they base, like the market will typically do this and that, and they're trying to time it and all that. That's not what you guys do, right?
No, but people do it.
Right.
It gets back. It's back to what I was talking about. People will they'll hindsight it, right? They'll look in the past and say, man, what patterns are there? And I remember as a child, before I even knew about financial advising, I was like, there's got to be a pattern, right? There's got to be, I'm going to study the Great Depression. I'm going to figure out what this pattern was. And that every time the market crashes, this probably happens first, and then I'll be able to, make all this money. That's not how it works.
But you did that as a child?
Yeah, as a kid, I thought about that. I mean, no, I didn't actually
do it. Brandon.
No, I didn't do it. I thought about it. I was like, there's got to be a pattern. There's got to be something, right? And obviously I never actually found the pattern.
No, but people still people will still look at those, and the only issue is that you never step in the same river twice. Thank you, philosophers.
And that's the problem. Future events are uncertain. Right. We have new dictators. We have new, there's just so many new things going on in the world that just because 1 + 3 + X = 10, X changes, right? Like the formula is constantly changing and evolving. So anyway, back to the numbers, the sell in May and go away. Bespoke Research did some looking into it and said since 1945, the S&P's median performance is 1% positive in May. Of all of the times, it was positive 60% of the time, but the average was up 1%. And so you might say, well, what if we have a really strong first part of the year like we've had this year, right? January through April was really strong. Because it's run up, does that mean May might be low and so we sell and go away? Well, they looked at that stat too. They said when the S&P has started out the year positive, the median has been 1.2% in May, and also positive 67% of the time. Now, I'm not saying this is like use this as your investment and so go buy in May if the market's been positive. The reality is things are just always changing, and people love static recommendations because it just makes it easy to understand.
Yeah.
And unfortunately, it's a complex subject. And so when someone gives you a rule like sell in May and go away, it's so tempting to jump on that and say, perfect, I'll do that. But you're likely going to miss out on some opportunity.
Well, let me follow up on that, Brandon. I forgot my question. It just slipped out of the top of my head. I was so excited to ask this question, and then I lost it.
While you're thinking of your question, right? I think it is interesting how many people that manage their own money hear a statistic like that and make investment decisions based off those statistics that are, if you change the measuring period, that statistic changes, right? You can use statistics to prove about anything that you want in life. If college statistics class taught me anything, it taught me that. And And so,
right. It taught me not to trust statistics.
and the 87% of them, are made up on the spot, including that one right there. Right. And so,
yeah.
but, I do think it's interesting how many people that are managing their own money will look at that and say, oh, but the year, the election year is 83%, whatever the number is, percent positive during that year, right? And so therefore I'm going to get invested during even if it's a presidential year, or second term, or, they have all these different things tied to everything under the sun, between politics to weather patterns to, months of the year, all of that. And so it's just easy to get lost in fairly meaningless statistics.
And it's also it's where people will, because if you're a newsletter, if you're an investment newsletter and you're trying to get subscribers, you need some headlines, right? And so what are the headlines? Last time this happened was 2 years before the Great Depression, right? Or last time this hasn't happened. But what's hard is I mean, things are random, right? That didn't necessarily cause it. Correlate. If there's one thing I learned from college stats, it's that causation
and correlation,
and correlation are not tied, right? Just because it's correlated doesn't mean that that's what caused it. And so I think that, when you're investing, making sure that you're remaining static and remaining, neutral on things. It's important to take big picture, and you can drill into individual things, but you have to make sure that you don't swing for the fences, right? And that is where the most financial plans I've ever seen get blown up is when someone swings for the fences. They say, I know XYZ company is just going to go through the roof. I'm putting all my money there, right? Or I know this strategy, and they do it. And you know what? Their assumption may have been correct, but then something else changes that they couldn't have foreseen, and it all blows up. And so I tell people that even if we had all the analytics in the world and the best analysts in the world and teams going over it, which we pretty much do, right? Via, all the things we subscribe to, we still can't predict the future. And so ultimately it comes down to, how do you build a portfolio that can withstand the downturns that are sure to come, as well as capitalize and take advantage of up markets when they're here as well. How do you do that? Well, you do that through a disciplined investment process.
Oh my gosh, I remember my question. Percentage, Brandon, what is the percentage of money someone, and this is all relative, of course, someone should, let a manager manage or help with or whatever, versus how much they should invest on their own and play with, I guess?
Most of our clients have us manage all of it, just because why would, if you got $1 million portfolio, why would you take $100,000 if you're not going to manage it as well?
Because you think that you can invest it, go to Vegas or whatever, or day trade and hit it big, and so you're going to take a percentage of that and self-manage it and for fun. That's what's your fun money budget, essentially, right? The money you can afford to lose, because we're going to give a professional the money we don't want to lose, and then maybe lose 1%, 10%.
Yeah, highly dependent on the financial plan, right? How much can you nailed it, right? How much can you afford to lose? That's wholly dependent on the plan. Some people can't afford to lose anything, and we need to be very careful with how we manage their money. Other people can afford to lose quite a bit, a large sum, right? And do they have the stomach to do it? If so, then yeah, we can do that.
And Rex, how much as a percentage, and it's all relative, you got to talk to your client and stuff, because someone's going to say, yeah, but I'm passionate about, say, horse riding or horse racing, and I'm going to buy a horse, and that's 10% of my overall portfolio or something or whatever. You know what I mean? Like, what's your feedback when somebody comes at you with something like that?
I think everybody's different, and so it does depend, but as long as their financial plan numbers work, even with that added risk, or if we take that out of the financial planning numbers and we just subtract it out in case that goes to zero, right? The horse dies. Then then
Which
that's
happened like
okay.
7 times last weekend, by the way.
I heard that that happened 7 times last weekend.
Kentucky Derby.
Yeah, it was Derby week.
Yeah.
And so I think that's okay. I think if it is something that you're passionate about, I think that there's a benefit, a mental benefit, and a longevity and a quality of life benefit to keeping yourself mentally acute, to keeping yourself mentally engaged and mentally active. And if that passion is the market and is managing your own money and investing and taking some risk, then, and you're in a financial position to do so, then I think that's okay to do with 5 to 10% of your portfolio. And I see people that will come to us that are doing that on occasions. And we have some clients that do that on occasions. Now, the reality is that they're probably taking significantly more risks with that 5 to 10% than what we're taking with the other 95% of the portfolio. And so the difficult thing emotionally becomes that they outperform us, especially in those big bull markets. And then they confuse, short-term risk and performance with the safety net and the longevity of the plan. And that's where people can get in trouble. And so, typically if somebody's doing that, we recommend that you rebalance that weighting back to kind of that 5 to 10% at some calendar point, whether it be the end of each year or whatever the case is, so that you're again keeping that amount that you're checking, in check, so that 5% doesn't grow to 40% of the portfolio, and you're taking 5 times the amount of risk with that money than what your plan can really tolerate. And so that's where it gets out of alignment.
Okay. All right, let's dive into the fourth question that you need to ask yourself. And if you can say yes to this, go ahead and manage your own money. Will my portfolio stay within 1% or 2% of a professionally managed portfolio? Brandon, speaking of, the numbers here, where are we at? How good is the everyday person versus a professionally managed portfolio?
So I kind of stole my thunder already on this one.
Yeah, a little bit. That's
Sorry.
okay. Yeah.
Sorry. But how good are individuals? It depends on the individual, and some can be good, some not so much. What I guess I caution, being a 401k advisor, right? We have quite a few actually 401k plans that I help manage, and I'll go in and it's crazy. Like sometimes you'll get one person that is running around like talking to everybody about the investment portfolios, and he's essentially becoming a financial advisor, telling all these people what to buy and what to sell. And I'll hear the rationale behind it, and it's crazy. Like I had one, I don't know, was worried about, not to go into specifics, but essentially people will get in their mind these different ideas of what a good investment strategy is, and they'll run around and tell everyone else around them, and everyone will follow.
Right.
And,
that's fascinating. And so where does that come from?
I think it comes from, again, like I said before, I think people want to understand, and you can understand. There's nothing stopping you from understanding exactly what we're doing. It just takes a little bit more time and discipline. And if someone can tell you in 2 sentences a theory or a hypothesis, that feels way better, right? Buy this because this happened, and I think this will happen in the future, right? And you can get your head around it, versus going through a properly diversified cross section, making sure you're not overweight in any one sector, making sure everything is diversified and we're not overexposed anywhere. I mean, that gets a little bit in the weeds and boring, but man, when your friend can tell you, buy this, put all your money in this mutual fund, because this is going to happen in the future, people get behind it. And we see that with gold, we see it with, individual stocks, we see it all over the place. And so I don't know. The other thing too that I see is someone will build out a portfolio that they think is really good. And let's say it is a good portfolio for them. His portfolio is not necessarily good for someone who's 20 years older than him, right? And so you've got to make sure that you're taking into account age, but also financial plans, right? Even 2 people who are 50 years old might have a completely different financial plan with different risk tolerances. And so, I mean, there's so many factors to take into mind. Taking, investment advice from a coworker is typically one of the worst ways to do it.
So, well, Rex, I was going to ask, like, because there's the performance of the actual investment, right? But then there's the overall financial picture. And so, can you explain the difference between the two? Because the friend giving advice or coworker giving advice has no idea what the overall picture is for someone, perhaps.
Right. The difference is the individual investment has its own rate of return for that individual investment, but then you have other outside investments that may not be in a retirement plan. They may not, it may be an IRA, a Roth IRA, it may be a non-qualified or non-retirement account. You may have savings, you may have CDs, you may have all these other pieces that are part of the complex puzzle. And that's what you're doing on planning is you're setting a target rate of return. Now, that doesn't mean that you're having to, that you're going to get a straight line. If your target rate of return is 6%, doesn't mean you're going to get 6% every year. It means that you may get, 10 one year, -5 one year, and it'll be all over the map. But you're trying to average that rate of return over time in order to meet the cash flow distributions that you need throughout retirement. And that's what you're trying to get your portfolio to do. And that's why if all of a sudden you start taking a flyer on part of your portfolio and that doesn't work out, that may severely handicap your ability to hit that target rate of return that you need to hit your retirement goals. Now, part of that is how tight is your plan to that goal, to that rate of return? Do we have it extremely dialed in tight to where if you're getting, a target rate of 5.5 versus 6, then you fall, really, really short? That's a pretty tight plan. And so, or is it something that we're targeting 6 because that's the risk level that you're comfortable with, but really we could hit 3 and we would be just fine, right? Because we have enough assets there to do it. And so it really is going to come down to that individual plan. But I think one of the things that I see as far as the biggest mistakes when somebody's managing their own money is they have, a handful of mutual funds from different fund families, out there that are 90% overlapping. They all own the exact same stocks. Mm-hmm. And so they think they're diversified because they have 5 different names on their statement. And they think that they've done their research, because they all have, these great historical rate of returns during the same market period because they're all invested in the exact same things. And so they think that that's a great way to manage that portfolio, when in reality, the next time the market shifts and you go through a different cycle to where something else performs and that grossly underperforms, then you've done an enormous disservice and you really don't recognize the amount of risk that you're taking by having that concentrated the way that you have. And I think that tends to be the most common, mistake of people managing their own money that I see. So,
and we talk about riding a portfolio out, right? If we hit a 2008 type environment, that can we ride it out on a well-diversified portfolio? The answer is yes. Yeah, we can ride it out. If you've done just like Rex said, right, and bought 5 mutual funds that have different names but effectively are invested in the same thing, and that sector is going to be damaged for a decade or two, you can't ride that out. Like you just have to take the loss.
And there's literally still technology funds that people bought in 99 for that example, Brandon, that bought in 99. You had the 2000 tech crash that today are still significantly underwater from that 99 purchase. Right. I mean, that's a great example of exactly what you're explaining.
Right. You can't just write anything out. And I think that comes down to, have you done your research? Have you really built out your portfolio intentionally and cross-checked it and made sure everything is diversified the way you think it is, so that when times get tough, that you can have that resilience to be able to ride it out?
Okay. So to wrap up this episode of Through the Pines, should I manage my own money? Brandon, as a financial planner, do you manage your own money?
Yes, but I actually do. I run most of my big decisions by Rex.
Yeah.
And I mean, it's good to have a friend. It's good to have a financial advisor, right? And even though, I mean, I'm completely trained in this, right? I advise other people. It still is so helpful mentally for me to call up Rex and say, hey, Rex, this is what I'm thinking. Tell me if I'm crazy.
Yeah. So then, Rex, as the senior advisor here, do you manage your own money?
So the answer to that would be, in a way, yes, because I manage our portfolios, right? Brandon and I manage our portfolios together, and my money is invested along with, in the similar manner to our clients. And so in a way, I would say yes. The reason I do it that way is because I am also human, and I am susceptible to getting emotional about my own money. It's really easy for me to not be emotional about Brandon's money or our Brandon's money. But it is difficult for me not to be emotional about my own money, even with all the experience, even with, everything that I know about the markets. It's still a difficult battle that you have to kind of fight. And so that's why, I just do it the same way that we do with clients for my own personal risk tolerance. And so I think if there's one takeaway from this podcast, well, there's lots of them, but if there's one takeaway from this podcast, it's that I heard Brandon say, it's good to have a friend that's also a financial advisor.
Yeah, for sure. Okay. Anything else, Rex, on managing your own money?
No, I think if you're having questions or, about that, then you ought to contact us and we can kind of talk through this in a little bit more detail for your specific situation. If you just want a second set of eyes on it, if you just want to bounce some ideas off somebody, we're here for you. So
awesome. Okay.
The other thing too is we really try and keep money liquid, right? And so if we have plenty of clients who will say, hey, let's try it. We'll try it for 5 months. If you don't like it, try it for a month. If you decide, hey, this isn't what I wanted, roll it back out. We're not handcuffing you to our ideas. And clarification, my money is invested in our portfolios, right? My personal retirement accounts, my other accounts, literally all of it is invested in the same manner that we would advise our clients to invest. And that feels good too. I tell people these portfolios mean everything to us, right? I mean, this is not only your money, but it's my money is invested the same way. My family, friends, clients, we really have a vested interest in making sure that we're doing the best we can with the money.
Good stuff. Thanks, Brandon. Okay, so this has been Through the Pines, our financial wizards this episode. Planwithbaxter.com. Rex Baxter, Brandon Smith, thanks so much for joining us. You can like our Facebook page, follow our Instagram at Pines_podcast. Best thing to do, so you can see our wonderful, beautiful faces, is to subscribe to our YouTube channel, Through the Pines Podcast. This has been Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.